and why they still have, in part, why they still have wealth in their family, is they have created their own private banking system leveraging life insurance. And so what that is we are essentially using the cash value in a way that allows you to access money at a more favorable term than you'll ever get at a bank. And you are literally, you'll be able to tap into it on your own terms, at your own pace, whenever you like. So if we got time to dive into it a little bit, I can.
Right.
Okay, cool.
Let's go.
So
Malik's First Job Podcast, here to answer any questions that y'all ask. Financial literacy and resources. Parents and young people becoming bosses. CEOs, future leaders, entrepreneurs. Conferences and boardrooms getting sponsors secured. If you want generational wealth, Brooklyn's own Kerwin Phillip with information to help. Malik's First Job Podcast. Malik's Podcast. Brooklyn's own Kerwin Phillip. Kerwin Phillip. Malik's First Job Podcast. Podcast. Brooklyn's own Kerwin Phillip. Generational wealth.
Hey, peace. What's going on, everybody? How you doing? This is Kerwin Phillip again with another episode of the Malik's First Job Podcast, where we focus on leadership, entrepreneurship, and financial literacy for parents and teens. Today, we're bringing back another guest that we had previously, Mr. Calvin Royster Jr. Remember, he came back in one of our earlier episodes talking about life insurance, but today we're going to take the next step, in that conversation, kind of build upon what we discussed in the first episode or the first interview that we did together. If you missed it, go back through the archives, check it out, then you can kind of catch up with this one. So Calvin is the owner of Anew Financial, of a full-service insurance brokerage with a focus on serving Black millennials in that community. He's been in the insurance industry for over 8 years and has helped thousands of people with their insurance planning over time. So, but today, again, like we said, we talked about life insurance, the importance of life insurance before, but now we're going to talk about it a little bit differently. Now, we often hear people speak about generational wealth and wishing that they did things differently when they were younger so that they could have a different present day, right? Mm-hmm. And oftentimes, we can't change what we did in the past because, again, the past has already gone. But What we can do is prepare our children or educate our children on the mistakes that we made or the opportunities that we missed out on, and give them opportunities. That way, when they get to our current age, they'll have a different conversation and different experiences, right? So one of those things that we speak about is, again, building wealth or having, wealth building strategies. So today, what I want to talk with Calvin about is, or Calvin, what I want to speak with you about today is how we can leverage life insurance, right? Because, there's so many different types. You have the term policies, whole life, different things. And I know there's different, they all have different purposes. Absolutely. Right? They can be leveraged differently for different results. So what I want to talk about today is how can we use life insurance as a tool or resource to help build, use it as part of our wealth building strategy. And as we can focus on our children that way, like as they're young adults and teens, things we can do when they're young that it gives them time to accumulate or build so that when they reach like mid-age, in their 30s and 40s, they have something to fall back on, right? Because we always say that children have an advantage because they have time. Yeah. So how can we leverage that time and the different resources out there to help them build a good strategy for wealth creation?
Man, you hit a lot of great points. So I thank you for opening that, and thank you for having me back, man. It's always a pleasure educating the community together. So, the first thing I'd like to point out is understanding that it's twofold. The wealth generating is one aspect of it, and just as equally as important is the wealth transfer. And this is the beauty of life insurance. Not only can we use this and leverage this with our children and our teens for their sake, for them building wealth, but we can also get the benefit of transferring that as well. And what I mean by that is, a lot of times as we go to, I think this generation and this day and age, it's going to be a lot more achievable. We've seen it more so in our community now that we are getting our hands on some money. Now the question is, how efficiently are we transferring the money? Because you can have $1 million and leave it, but depending on how you have the $1 million and what type of account it's in and how you're transferring makes a difference of, are they getting $1 million or are they getting $600,000?
Okay.
So life insurance is one of those things that is protected by so many tax laws and things like that make it beneficial to transfer. So it's definitely a twofold thing, and that's why talking about it with the young ones is so pivotal, because it also is a long-term game. This has been around for decades and centuries. It ain't going nowhere, and countless families, oftentimes that don't look like us, have benefited from it at a different level. And so talking to them about it while they're young allows them to have time on their side. And this is how we start to chip away at that wealth gap that we have between us and other ethnic groups. So, but yeah, so as far as how we leverage it with the youth, understanding that life insurance does have a financial component. It can be utilized as a financial tool. We can do all that stuff on the money side, but before we get to that, we've got to understand how life insurance works. Life insurance is going to be based off of your life, your health, right? So in that, oftentimes, it's, as a child, you're more than likely going to not have any health issues or challenges that would prevent you from getting covered. So that's the first thing. Your insurability is there. So you have that, you're able to get it. We can even talk to this, these concepts. The other part is making sure that we look at the affordability piece of it, because while they're younger, because it's also based off of your age alongside your health, is making sure that we can take advantage of this stuff, because it's at price points that works for everybody typically, because they are younger. Your age is good, and your health is on your side as well as a child. So we get these policies for these children, and what we'll do is, again, everyone has a different function, but generally for the youth, because of the affordability, we're looking at some more, but we'll call them advanced concepts. We're looking at permanent products. We're looking at building cash value. Again, these things take time. We get these policies that can accrue cash value, which, if you didn't catch the first episode, is simply, I believe we shared it on there. It's as simply as you're paying into your policy, this is money that you can in turn use, borrow against leverage for other opportunities. So start these policies when they're little. We put this money into it, and we pay these premiums. A piece of it's going to this cash value. It's growing over time, right? And then when they get into those mid-age years, as you referred to, those 30s, those 40s, they're ready to go buy a house if they haven't already, or get married, or whatever it may, start a business. They have this additional nest egg that's already there, that was guaranteed, and this, that, and the other, that they can tap into for those things. So that's kind of how the process starts with that and getting them going.
Okay. So when you say cash, so that's the cash value side, right?
Correct.
Now, is there a difference between cash value and permanent policies, or is it the same thing?
Yeah, so permanent policies will typically come with cash value. Not everyone does, but most of them are going to come with a cash value benefit.
Okay.
So that's important as well, making sure that if that's what you're wanting to do, that you, one, are in the right product. So talking to somebody who knows the different ones, but then also, two, that you are designing them to allow you to maximize the growth in your dollar, because they are very customizable and you can design them differently. So knowing, or at least working with somebody that knows how to design them for you is going to be important to make sure that you are getting your desired end goal.
Right. So so how old or how young can a child be to get a policy?
So as young as 14 days.
14 days.
14 days. Yep, that's the cheapest it'll ever be in their life. So, but yeah, as young as 14 days is when you can get it. And again, the sooner you can get it, the better, because affordability is going to be there, and we have to worry about those health challenges.
Right. So let's start there. So at 14 days, okay, a newborn baby, what type of policy would you recommend that like a parent would get for a newborn child?
So, I would definitely go on the permanent side of things.
Okay.
Um, that way, there's something that'll last them their entire life. You're going to have that cash value benefit. And when they become an adult, they can take the policy over. And this is how we're building that generational wealth. And eventually, when they pass way down the road, right,
Hmm.
that's going to be left for the next generation. So you've essentially started something that is going to go on generations beyond you. So I would definitely recommend a permanent policy. The type will depend on, the type of permanent policy will come down to budget and things like that, and what the other financial goals are.
Okay. Okay. So what are the different options of permanent policies?
Sure. So I think the most common one people refer to is going to be whole life.
Okay.
Then you've also have universal life, which has two different routes you can go. So you have a standard universal life policy. Then you have one that offers the benefit of indexing. So that's another really popular one nowadays. It's kind of gotten a lot of traction now due to social media, but index universal life, or IUL, is what you may have heard it referred to as well. So those are the three different types of permanent policies.
Okay. So what are the key components of each one? So let's start off with the whole life. Like what makes a whole life policy?
Sure. So it's just like what it sounds. It covers you for your whole life. It's pretty straightforward. The benefit of doing a whole life is it's the one it's Old Faithful. You're going to get your fixed interest rate. There's not a lot going on there. It's very straightforward. Average now, it did take a hit. I want to say maybe a year or two ago, they updated the laws to where insurance companies were saying, hey, we can't maintain this 3% guarantee that we have. And they updated the law to where they could drop it down to 2%. So you'll find on average, you'll get about 2.5% interest on your cash value growth. So going back to you're putting money and paying every month, and this cash value account is growing. Once a year, what you're going to do is you're going to get credited the interest, just like a bank account would, and so that's about 2.5%. So that's the whole life side, and it comes with all the same features as the other two.
Okay. And then what about the universal? Well, what makes that what it is?
So universal is like a hybrid almost.
Okay.
It's tricky because this is the one, if you go this route, a lot of flexibility, a lot of options. You can get very creative on the side, and there's a lot that you can do with it. But I cannot stress enough that if you go the universal route, it can be very good and it can promise a lot. But if you don't do it the right way, this is going to be the one that's going to have you very upset, and has before, especially back in the 80s when they first rolled out, caused a lot of issues for people down the road because they weren't set up correctly. So done correctly, they're amazing. Not done correctly, they're a nightmare. But universal, again, it's more of a hybrid. So basically, it's you get a policy, and you can have it last as long as you want. Now, people that do this, we get it to set them up for their entire lives. From there is some that will come with a cash value component. Other ones, it's so minimal that we don't even say that there's cash value there. And then from there is an interest rate. Some companies, there's one now that offers their right around 4% interest on their universal life. But that's universal life in a nutshell.
Okay. Now you mentioned that there's, I guess, a correct way and an incorrect way to set it up. What's the difference between the two? Like, what would you say is the right way to do it, and what is the not so right way to do it?
Sure. So essentially, what it boils down to is they have to be funded correctly. That's the big difference. How it's funded. How we determine the funding is based off of the amount of death benefit that we select, and how that death benefit does or does not grow. So your funding has to support the death benefit. What we want to do when we're on this side of it, we're doing these universals, whereas the regular universal or the IUL, is we're doing it to be aggressive in our cash value growth. So we want to fund as much as we can. So on this side of it, we want to design it to where we are allowing you to put as much money into it that you want to do. The issue is sometimes it's not set up to where there's enough funding to allow you to get that growth that you want. So I guess the easiest way to put it without showing numbers is you want to get the lowest death benefit and the highest amount that you can put into that as possible. It's probably the easiest way to put that.
Okay. All right. Then finally, like the index universal, is that life policy? Well, what's the standards with that one?
So it's basically just like the universal life, same pros and cons. However, you get the added benefit of index crediting, which is simply instead of your money physically being in the stock market, which right now a lot of people have been hesitant about, and rightfully so, you can do an index fund, which simply says, well, your money won't physically be in the market, but based off of market performance, you can participate in the wins. Now, you won't get the full win, but we'll share in the win. And on the other side of that, if the market loses, we'll eat the loss as the company. And so there's a give and a take there. So case in point, if the market goes from year to year, goes, let's say 10%, it increases 10%. Right. You won't get the full 10% necessarily, depending on what kind of index crediting you're in. But you might get 5 or 6%. But most people aren't mad about that 5 or 6% of the 10 because they know if it went down 10%, worst case, their money is zero. There's a 0% loss. So it just evens out. Okay. So the fact that you don't have to worry about risking any principal there makes the index crediting very powerful. So same concept as UL, but you get the index crediting, so you can be a little bit more aggressive than even the 4% that I've seen.
Okay. So now let's say if I was to start my child off at the newborn stage, they're 14 days old, and I get them with a policy, and they are quoted X amount of dollars, right? It'd be fairly cheap. Will they maintain that same premium throughout that whole life, or does it change? It does it increase over a period of time?
Great question. So depending on the policy, so that's another thing. Some companies, and there's one that's pretty popular, are designed to change when they get older. So you might see that impact. But yeah, generally speaking, it's supposed to be the same, especially if you're doing the permanent side. If you're doing a term on them, then yeah, that when the term comes up, they'll have to pay more. But on the permanent side, it should be the same generally.
So let's say, let's throw in some numbers out there. So let's say you got a $1 million policy for your newborn, and you're paying $20 a month. So at the time, you get the whole life permanent policy. Right. So you mean to say when the child is 20 years old, are they, if they got the right type of policy, they'll be paying that same premium?
Exactly. And that's the power of it, because we know at some point in time it's going to get purchased. With us, it's a matter of we're waiting till the end, so it costs a lot more, right? So then we got to pay $200 to get $50,000 worth of coverage. Whereas if we put it on them while they're kids and they take it over as adults, they might not even pay $50 for it. You know what I mean? So that's one of those things. And I was actually looking this up earlier. There's actually a stat that Forbes put out that said we're 22% of our community actually understands that life insurance is a wealth generating or a wealth building tool, opposed to our counterparts, which is only 8%, which is actually surprising to me, which I think goes to show to me two things. One, we are understanding the value of getting life insurance. The second thing is we just need to understand better how to use it. We got to use it. If we use it a little bit different, it'll be more beneficial for us, because oftentimes that was rooted in, from my experience, just seeing our families, again, wait till later on in life. And so we're getting it, but we're getting small policies just to cover the funeral, which isn't bad. Like, that's a good starting point. But for us to make a shift, we've got to get it earlier, get bigger amounts while it's more affordable. And we can start doing some of these more of these nuanced avenues of life insurance and using it for different things that can benefit us while we're still here. It's not just to cover funeral costs. It's a lot more than that now. So,
right. Today is a great day to start your own podcast. Whether you're looking for a new marketing channel, have a message you want to share with the world, or just think it would be fun to have your own talk show,
Podcasting is an easy, inexpensive, and fun way to expand your reach online. Buzzsprout is hands down the easiest and best way to launch, promote, and track your podcast. Your show can be online and listed in all the major podcast directories like Apple Podcasts, Spotify, Google products, and more within minutes of finishing your recording. Podcasting isn't hard when you have the right partners, and the team at Buzzsprout is passionate about helping you succeed. Join over 100,000 podcasters already using Buzzsprout to get their message out to the world. Let's create something together. Follow the link in the show notes and let Buzzsprout know that we sent you, and that will get you a $20 Amazon gift card if you sign up for a paid plan and help support our show. Thank you very much, and let's be great podcasting together. Peace. Malik's First Job, Financial Principles for Teens, is an excellent resource to get your children started on understanding the basics of financial literacy. This book, which is set in Brownsville, Brooklyn, about a young man who gets his first job and then shortly thereafter sits down with his dad to learn how to manage his money. There are several topics that are covered within this work, such as paying yourself first, disciplining your spending, knowing the difference between an asset and a liability, creating multiple sources of income, as well as the importance of being charitable. So again, if you want to get your children started on understanding finance and becoming responsible adults, we highly recommend that you purchase the book, Malik's First Job, Financial Principles for Teens. So please visit maliksfirstjob.com to get more information. Peace.
Right. So let's say a child is locked in, right, at a particular rate, and then later on, and again, we're still talking about permanent policies, and there's some type of health change, like later on in life. Is there like a follow-up health exam, or does the rate stay the same? You know, how does that impact on the permanence? Like, I know if you have a term policy, and let's say at the end of that term, then you have to renew, then you may have to take another health exam in between.
Right.
But how does that impact on the permanent side?
I love that question. So generally speaking, you'll get what's called guaranteed insurability on probably 9 out of 10 policies now. So what that says is essentially, well, for one, if there's no increase in coverage, doesn't matter if they have a health challenge, they're fine. But if, let's say, down the road, they do have a health challenge and you say, you know what, we should probably up that policy. Most policies have guaranteed insurability built into it, which says they are allowed to increase the policy as long as they pay the difference in premium with no health questions. They could have literally just got out of the hospital from a heart attack in their whatever age, and they can turn around and increase their coverage, and all I have to do is pay the difference. There's no health questions involved because they guarantee we've insured you now, we've got you for life, and we'll guarantee it as long as you keep that policy open.
Okay. All right. So another question is, let's say, so we have is there like a difference in strategy for like a newborn child versus, let's say someone missed the mark at insuring their child when they were, newborns. And now they wait until, let's say the child is, in high school or entering college. Is there a difference in strategy versus those two various age groups, or do we do the same thing?
We don't have to deviate too much. I think the only difference would be more so on the parents' policy, because they're now in college. So, one of the things that we can do with insurance, the life insurance piece and the financial component of it is we can use it and put away almost like a college savings plan. So if we do that early enough, that's on the table. But when you're about to be in college years, because it's a long-term thing, we simply won't have enough time to really do something like that without a significant amount of money. So that'd probably be the only thing that we'd have to shift. But other than that, just covering the child, you wouldn't have to deviate. It would really just come down to the budget that would dictate which route we would go.
Okay. Now, how old does a child or person have to be to own their own policy?
To own the policy, they'd have to be at least 18. They have to be an
At
adult.
18. Okay. Now, let's say if a parent has an 18-year-old, but they feel that 18-year-old is not quite responsible enough.
Yeah.
Right?
I know I wasn't. Good Lord.
Right. So
When
they
you
don't
trust me
feel
with
like.
the car. I'm sorry. Go ahead.
What's that? What you say?
What'd you say?
What you say?
I said, couldn't even trust me with the car at 18, man. That was a rough one.
Yeah. Right. So, so let's say the child is 18 and the parent doesn't feel the child's quite responsible enough to own the policy.
Okay.
And can the parent own the policy at that age? And if so, is there a time when it has to be switched over, whereas like a person can't own the policy for another individual?
As far as a time frame to pass it over, no, there's no issues on that. As far as can the parent be the owner? Absolutely. So that's pretty common. Even in the adult years, sometimes
Okay.
you'll see that it comes down to responsibility. And also the inverse. If you got a parent that's maybe a little bit older, you might see the child become the owner of the policy. Normally, if they're the one that's handling the parent's business, you may see that. So,
right. Okay. Cool. All right. So I guess how would a parent start? Because what's like the first steps they would take to I guess get started on getting leveraging life insurance for their children to get started. I guess what's the first step they would have to do?
So the first step I would always suggest is figure out the budget piece of it, because that's ultimately going to dictate the path. Because again, looking at what would prohibit you from doing certain things with life insurance is going to be your health and your age, and then the money. So we know the health and the age are on our side. So now it's just the money. So figuring out the budget, I would sit down with yourself and review your own personal budget, or with the spouse, sit down and say, okay, how much do we have for this, and then figure out. Figuring out the budget would be the first thing. I would also encourage parents as well. Once you have that budget discussion, even though I only do life insurance, I would still encourage you to look at some sort of investment at some capacity, because they do have a lot of time is still on their side. So regardless of what the market is doing right now, we know over the long term, history says the market is going to win. So figuring out and taking time to educate ourselves as parents, because I've got a little one as well, different avenues to invest as well outside of insurance is something I would encourage. So if you've got a set amount, you've got $200-$300 that you have in cash flow, excess cash flow, that you can do for your kids. I would say, yes, put some aside for life insurance. And I would also say put some aside for some investments, and talk to a financial professional about that portion of it as well.
Right. Okay. All right. So that'd be first, figure out the budget, and see what you can afford to put towards this life insurance policy, or pay towards a premium. Then you'll consult with a advisor, or get in contact with like an agent to see who can get you in the right route. That's correct.
Exactly. And then from there, like you said, have a professional kind of guide you through the different options. Again, it's a lot that can be thrown at you. So what I would say we watch out for is I would definitely say at least have a discussion with somebody that knows either about private banking. Sometimes infinite banking is used, or interchangeable. Somebody that knows how to build cash value and things like that. And reason being, because again, those type of things are very powerful tools that can be leveraged for a lot of things. And so talking with somebody who knows how to set you up for that would be very important. So that's kind of one of the things I would say I would throw out there, because you're going to see a lot of information. Social media has been great because it has provided us and cut into some of that information gap that we've had.
Right.
At the same time, it's a lot of information that's out there in snippets. And so, there's a lot of information out there. You got to take what's good and throw away the rest. But I would definitely say start with that. That's something you should look for as well.
Yeah. Now, I've also heard people say, talking about social media, they said, if you leverage, your life insurance correctly, you can be your own bank.
Absolutely.
Right. Can you elaborate on that a bit?
Yeah, so essentially at a high level, what we're doing is we're removing the need of a lot of the traditional uses for lending money from a bank or borrowing money from a bank. So, if you think about you need to go to the bank, you have to put in an application, you got to worry about credit approvals, you got to worry about debt to income ratios, you got to go through all these hoops and hurdles. And we already know the banks and the history with us as a people and how there are discriminatory issues there.
Right.
So, there's all that at the bank. Not saying obviously you don't ever get money from the bank, but that's what we know is the existing relationship with the bank. So, what is another option, and this is what wealthy families like the Rockefellers have been doing, and why they still have, in part, why they still have wealth in their family, is they have created their own private banking system leveraging life insurance. And so, what that is we are essentially using the cash value in a way that allows you to access money at a more favorable term than you'll ever get at a bank. And you are literally, you'll be able to tap into it on your own terms at your own pace whenever you like. So if we got time to dive into it a little bit, I can.
Right.
Okay, cool.
Go.
So here's what some of the terms can look like. So when we're setting up a private, when I'm sitting down with somebody and we're setting up a private banking system, we'll go through, okay, what are your goals? Where would you like to be? What kind of money are you working with that, is an excess that you can use for something like this? We get that figured out. How healthy are you? Can you qualify for this type of policy? Then we'll open it up. And, we'll put into it over time. And what will happen is down the road, as you've been building into it, you'll be able to tap into the money. What I mean by that is, let's say you are, you want to go start a company in a few years. You'll need capital. So if we know that we're projecting to start a company in a few years and we're going to need capital later, why not start putting away for it now? Instead of putting it away in a savings account, you could reroute it in a tool like this, because we know the savings account at the bank is going to give you, if you're lucky, 0.01% interest. So, and on this side of it, we're talking on the low end, 2% interest, 4%, and even higher than that, depending on, the route that makes sense. So we put it in an account like this. It's going to grow. It's going to grow. It's going to grow. Now comes time where you're ready to get money to fund your business.
Right.
So again, we know what the bank is going to do. Credit applications. You got to debt to income ratios. You got to be good enough to get the money. Over here, because you are the bank, you don't have to do that. You just simply call your agent. You call your company. Say, hey, I need this much of my amount that's in there, and they cut the check. Right. Now, here's the terms that makes it so attractive. When you go to borrow the money, the cost to borrow it is next to nothing, which is so attractive. So you go, let's say you've got $10,000 in this account, and you need to borrow $9,000 of it to start your company. That $9,000 that you borrow against yourself is only going to be you're only obligated to pay back the interest in that first year. So interest is generally, is volatile, but it normally fluctuates around 4%.
Okay.
$9,000, you got to pay 4% of $9,000. So what's that? It's probably like $400. We'll call it about $400. You pay $400. You have a year to pay it. I always encourage just pay it up front, so you don't have to worry about it. Now you've got a year to go, make your investment, to go flip your money, right? Or however long you want to pay it back. The $9,000, you pay it back on your terms. You could pay it back in 30 days. You could pay it back in 30 years. It really doesn't matter, because this is your money, right? So that's kind of how that works. And then there's a lot of different things that we can do and set it up over long term. But that's where it starts getting exciting. When we start realizing we have something of value here built up for us, and then when we access it, we do it in a way that is going to be more beneficial than it would be through a traditional bank. Mind you, all because it's protected with insurance. And this is how a lot of people have benefited from doing something. I'm trying to use my words carefully here. A lot of people have benefited from this. Is it's got the tax benefit as well. So when we're doing this, I coach my clients on to do it in a way that does not create a taxable event.
Okay.
So you take this money and you go make you more money. You only had to pay 4% interest, which didn't cost you much. It was a few $100, depending on how much you borrow. And then on top of that, that's not a taxable income that you're reporting based off of what you got from the policy. So from that, now we're moving tax efficiently and making our dollars work for us. Now, the last part to that is, let's say that again, you got 10,000 in account, you took 9,000 to go fund your business, and you all this money over here with the business funded. Now, the following year comes up because you get your index crediting generally in once a year. So the next year rolls around. You haven't paid that $9,000 off, but your credit, let's say you have a 5% credit coming, right? Your 5% credit is going to be based off the 10,000 that was in there because you never took it out, opposed to the 1,000, if that makes sense. Instead of that 10 minus 9 hit the 1,000.
Yeah.
So again, if you do it appropriately, you've now took the money out without having to worry about income taxes on it. You also got a very favorable payback terms on it. And then on top of that, you were able to, what's the last one I was talking about? The
index.
And you get the index credit. I'm sorry, I get so excited, I'll be moving too fast. But yeah, so the last part is the index crediting part. So you get that in addition to it as well. So you get the growth on what was in there because we never took it out. So if you do it appropriately, there's a lot of different benefits you can get from doing it. And that's basically, in a nutshell, how we're utilizing and creating your own banking system attached to a life insurance policy.
Okay. So I guess as far as the interest, so is that like a one-time hit on the interest? Where you just pay like $3-4 up front, and then there's no other interest to pay throughout the repayment terms?
No, that's it.
So then the rest of it, you're just paying on the principal after that. Wow.
Exactly. So people that get really excited about it, real estate investors love it, especially if you can put some, there's more advanced things we can do to how we design it. But in a nutshell, you can put the money into it. If you know you're about to flip a house and you're going to turn it in, 30, 60 days, the cost to borrow 4% interest,
right?
Versus you can go get a what do they call them? A high, what do they call those loan guys? The for the real estate, I'm trying to think. What are they called? I can't believe I can't think of. We'll call it a high risk loan, not a credit loan. We'll call it a high risk loan.
I know you're talking about. I can't think of the term either.
Hard money lenders.
Yeah.
Wow.
Wow.
So yeah, I can't believe I couldn't think of that. So yeah, so as opposed to going to hard money lender, they might charge you 12, 20%, whatever it may be in all their terms. If you have the money in your account to go make this purchase, this acquisition, it just makes sense. You've got an interest only loan, essentially a 1-year interest only loan, essentially, but you'll pay it back up front. And you've got as much time as you need to pay the principal back. If you know you're flipping the house and you'll be done in a few months, worst case, it takes you a year. It doesn't matter. You can pay it back at your own terms, right? You want to pay it back as soon as you can because then you can use it again. You can rinse and repeat. But that's how that works. And while your deals are out there, your transactions are working themselves, you're still getting index crediting based on what's in the account. Exactly. So it's very powerful. Your money's working for you even when you're using it to go work for you, so.
Yeah, that's deep.
Yeah.
Cool. All right. So if anybody wants to get more information or get in contact with you, how can they do so?
So I'm on most of social media. I'm getting there. So, but Facebook, LinkedIn, you can find me under Calvin Royster, my name. Instagram and TikTok, _Insurance Bay is how you can find me.
Okay, great. So again, just want to thank you again for coming on. Are there any closing thoughts you want to share before we wrap up?
No, man. Again, just thank you for the time, and I appreciate this as an opportunity to spread out the education around it. I will say that there's a lot of, again, information being shared about it. A lot of agents are jumping on the wagon of trying to get in front of people to talk about the private banking concept and things like that. Right. Not everybody is proficient at it yet. And so I just encourage and implore people that are looking into it because it is something that is a very powerful tool that they do the due diligence and making sure that they feel good about who they're working with.
Okay, great. All right. So again, thank you, Calvin, for joining us today. People, again, thank you for tuning in on another episode of the Malik's First Job podcast. digest this information, follow up with Calvin if you want more information, or if you're not in the area, reach out to someone in your area that can kind of help guide you, on this right direction, on the path of leveraging life insurance. And again, and also be careful when you're on the internet, because there's some folks that have you doing some crazy stuff that'll have you jammed up. So you want to go ahead and make sure you do your due diligence, research, investigate. Don't believe everybody that you see. Go and, do your due diligence and find out, make sure the information is correct. All right. Yeah. So again, take care and have a good one. We'll see you next week. Peace.
Generational wealth.